Chapter 8. 5 Don'ts for Investors. 1. Don't buy into promotional companies. Close to the very heart of successful investing is finding companies which are developing new products and processes or exploiting new markets. Companies that have just started or are about to be started are frequently attempting to do just this. Many of them are formed to develop a colorful new invention. Many are started to participate in industries such as electronics, in which there is great growth potential. Another large group is formed to discover mineral or other natural wealth, a field where the rewards for success can be outstanding. For these reasons, young companies not yet earning a profit on their operations may at first glance appear to be of investment value. There is another argument which frequently increases interest. This is that by buying now when the first shares are offered to the public, there is a chance to get in on the ground floor. The successful company is now selling at several times the price at which it was originally offered. Therefore, why wait and have somebody else make all this money? Instead, why not use the same methods of inquiry and judgment in finding the outstanding new enterprise now being promoted as can be used in finding the outstanding established corporation? From the investment standpoint, I believe there is a basic matter which puts any company without at least 2 or 3 years of commercial operation and 1 year of operating profit in a completely different category from an established company, even one so small that it may not have more than $1 million of annual sales. In the established company, all the major functions of the business are currently operating. The investor can observe the company's production, sales, cost accounting, management teamwork, and all the other aspects of its operations. Perhaps even more important, he can obtain the opinion of other qualified observers who are in a position to observe regularly some or all of these points of relative strength or weakness in the company under consideration. In contrast, when a company is still in the promotional stage, all an investor or anyone else can do is look at a blueprint and guess what the problems and the strong points may be. This is a much more difficult thing to do. It allows a much greater probability of error in the conclusions reached. Actually, it is so difficult to do that no matter how skillful the investor, it makes it impossible to obtain even a fraction of the batting average. For selecting outstanding companies that can be attained if judgment is confined to established operations. All too often, young promotional companies are dominated by 1 or 2 individuals who have great talent for certain phases of business procedure but are lacking in other equally essential talents. They may be superb salesmen but lack other types of business ability. More often they are inventors or production men, totally unaware that even the best products need skillful marketing as well as manufacture. The investor is seldom in a position to convince such individuals of the skills missing in themselves or their young organizations. Usually he is even less in a position to point out to such individuals where such talents may be found. For these reasons, no matter how appealing promotional companies may seem at first glance, I believe their financing should always be left to specialized groups. Such groups have management talent available to bolster up weak spots as unfolding operations uncover them. Those who are not in a position to supply such talent and to convince new managements of the need of taking advantage of such help will find investing in promotional companies largely a disillusioning experience. There are enough spectacular opportunities among established companies that ordinary individual investors should make it a rule never to buy into a promotional enterprise, no matter how attractive it may appear to be. 2. Don't ignore a good stock just because it is traded over the counter. The attractiveness of unlisted stocks versus those listed on a stock exchange is closely related to the marketability of one group as against the other. Everyone should recognize the importance of marketability. Normally, most if not all buying should be confined to stocks which can be sold should a reason, either financial or personal, arise for such selling. However, some confusion seems to exist in the minds of investors as to what gives adequate protection in this regard and what does not. This in turn gives rise to even more confusion concerning the desirability of those stocks not listed on any exchange. Such stocks are commonly called over-the-counter stocks. The reason for this confusion lies in basic changes that have come over common stock buying in the last quarter century. Changes that make the markets of the 1950s very different even from those as recent as the never-to-be-forgotten 1920s. During most of the 1920s and in all of the period before that, the stockbroker had as customers a relatively small number of rather rich men. Most buying was done in large blocks, frequently in multiples of thousands of shares. The motive was usually to sell out to someone else at a higher price. Gambling rather than investment was the order of the day. Buying on margin, that is, with borrowed funds, was then the accepted method of operation. Today, a very large percentage of all buying is on a cash basis. Many things have happened to change these colorful markets of the past. High income and inheritance tax rates are one. A more important influence is the tendency toward a leveling of incomes that continues year after year in every section of the United States. The very rich and the very poor each year grow smaller in number. Each year the middle groups grow larger. This has produced a steady shrinkage of big stock buyers and an even greater growth of small stock buyers. Along with them has come a tremendous growth in another class of stock buyer, the institutional buyer. The investment trust, the pension and profit-sharing trusts, even to some degree the trust departments of the great banks do not represent a few big buyers. Rather, they are a few professional managers entrusted with handling the collective savings of innumerable small buyers. Partly as a result of all this, and partly as a cause helping to bring it about, basic changes have come in our laws and institutions as they affect the stock market. The Securities and Exchange Commission has been created to prevent the type of manipulation and pool operation that spurred on the rampant stock market gambling of the past. Rules are in force limiting margin buying to a fraction of what was formerly considered customary. But most important of all, as already discussed in an earlier chapter, the corporation of today is a very different thing from what it used to be. For the reasons already explained, today's corporation is designed to be far more suitable as an investment medium for those desiring long-range growth than as a vehicle for in and out trading. All this has profoundly changed the marketplace. It undoubtedly represents tremendous improvement, however, at the expense of marketability. The liquidity of the average stock has decreased rather than increased. In spite of breathtaking economic growth and a seemingly endless procession of stock splits, the volume of trading on the New York Stock Exchange has declined. For the smaller exchanges, it has almost vanished. The gambler, the in-and-out buyer, and even the sucker trying to outguess the pool manipulator were not conducive to a healthy economy. They did, however, help provide a ready market. I do not want to get involved in semantics. Nevertheless, it must be realized that this has resulted in the gradual decline of the stockbroker and the rise of what might be called the stock salesman. So far as stocks are concerned, the broker works in an auction market. He takes an order from someone who has already decided on his investment course. He matches this order with an order he or some other broker has received to sell. This process is not overly time-consuming. If the orders received are for a large rather than small number of shares, the broker can operate on a very small commission for each share handled and still end the year with a handsome profit. Contrast him with the salesman who must go through the far more time-consuming routine of persuading the customer on the course of action to be taken. There are only a given number of hours in the day. Therefore, to make a profit commensurate with that of a broker, he must charge a higher commission for his services. This is particularly true if the salesman is serving a large number of small customers rather than a few big ones. Under today's economic conditions, small customers are the ones most salesmen must serve. The stock exchanges are still primarily operating as a vehicle for stockbrokers rather than stock salesmen. Their commission rates have gone up. They have only gone up, however, about in proportion to that of most other types of services. In contrast, the over-the-counter markets work on a quite different principle. Each day, designated members of the National Association of Securities Dealers furnish the newspapers of that region with quotations on a long list of the more active unlisted securities of interest to stockholders in that locality. These are compiled by close contact with the over-the-counter houses most active in trading each of these securities. Unlike those furnished by the stock exchanges, these quotations are not the price ranges within which transactions took place. They cannot be, for there is no central clearing house to which transactions are reported. Instead, these are bid and ask quotations. Such quotations supposedly give the highest price at which any of the interested financial houses will bid for each of these shares and the lowest offering price at which they will sell them. Close checking will nearly always show that the reported quotations on the bid or buy side are closely in line with what could be obtained for shares at the moment the quotation was furnished. The sales or ask side is usually higher than the bid by an amount several times greater than the equivalent stock exchange commission for shares selling at the same price. This difference is calculated to enable the over-the-counter house to buy at the bid price, pay its salesman an appropriate commission for the time spent in selling the security, and still leave a reasonable profit after allowing for general overhead. On the other hand, if a customer, particularly a large customer, approaches the same financial house with a bid to buy the stock so that no salesman's commission is involved, he can usually buy it at the bid price plus just about the equivalent of the stock exchange commission. As one over-the-counter dealer expressed it, we have one market on the buy side. On the selling side we have two. We have a retail and a wholesale market, depending partly on the size of the purchase and partly on the amount of selling and servicing that is involved. This system in the hands of an unscrupulous dealer is subject to obvious abuse. So is any other system. But if the investor picks the over-the-counter dealer with the same care he should employ in choosing any other specialist to serve him, it works surprisingly well. The average investor has neither the time nor the ability to select his own securities. Through the close supervision dealers give the securities they permit their salesman to offer, he is receiving in effect something closely resembling investment counsel. As such, it should be worth the cost involved. From the standpoint of the more sophisticated investor, however, the real benefits of this system are not in regard to buying. They are in regard to the increased liquidity or marketability which it produces for those unlisted stocks he may desire to own. Because the profit margin available for dealers in such stocks is large enough to make it worthwhile, a great many over-the-counter dealers keep a regular inventory of the stocks they normally handle. They usually are not at all reluctant to take on additional 500 or 1,000 share lots when they become available. When larger blocks appear in their favorite issues, they will frequently hold a sales meeting and put on a special drive to move the shares that may be available. Normally, they will ask a special selling commission of a point or so for doing this. However, all this means that if an over-the-counter stock is regularly dealt in by two or more high-grade over-the-counter dealers, it usually has a sufficient degree of marketability to take care of the needs of most investors. Depending on the amount offered, a special selling commission may or may not be required to move a large block. However, for what is at most a relatively small percentage of the sales price, the stock which the investor desires to sell can actually be converted into cash without breaking the market. How does this compare with the marketability of a stock listed on a stock exchange? The answer depends largely on what stock and on what stock exchange. For the larger and more active issues listed on the New York Stock Exchange, even under today's conditions, a big enough auction market still exists so that in normal times but the largest blocks can be moved at the low prevailing commission rates without depressing prices. For the less active stocks listed on the New York Stock Exchange, this marketability factor is still fair, but at times can sag rather badly if regular commissions are dependent on when large selling orders appear. For common stocks listed on the small exchanges, it is my opinion that this marketability factor frequently becomes considerably worse. The stock exchanges have recognized this situation and have taken steps to meet it. Nowadays, whenever a block of a listed stock appears which the exchange thinks is too big to market in the normal fashion, permission may be given for the use of devices such as special offerings. This simply means that the offering is made known to all members who are given a predetermined larger commission for selling these shares. In other words, when the block is too large for the brokers to handle it as brokers, they are given commissions large enough to reward them for selling as salesmen. All this narrows the apparent gap between listed and unlisted markets in a period such as the present, when more and more purchases are being handled by salesmen rather than by brokers who just take orders. It does not mean that from the standpoint of marketability a well-known, actively traded stock on the New York Stock Exchange has no advantage over the better over-the-counter stocks. It does mean that the better of these over-the-counter stocks are frequently more liquid than the shares of many of the companies listed on the American Stock Exchange and the various regional stock exchanges. I imagine those connected with the smaller stock exchanges would sincerely disagree with this statement. Nevertheless, I believe an unprejudiced study of the facts would show it to be true. It is why a number of the more progressive of smaller and medium-sized companies have in recent years refused to list their stocks on the smaller exchanges. Instead, they have chosen the over-the-counter markets until their companies reach a size that would warrant big board, that is, New York Stock Exchange listing. In short, so far as over-the-counter securities are concerned, the rules for the investor are not too different from those for listed securities. First, be very sure that you have picked the right security. Then be sure you have selected an able and conscientious broker. If an investor is on sound ground in both these respects, he need have no fear of purchasing stock just because it is traded over the counter rather than on an exchange. 3. Don't buy a stock just because you like the tone of its annual report. Investors are not always careful to analyze just what has caused them to buy one stock rather than another. If they did, they might be surprised how often they were influenced by the wording and format of the general comments in a company's annual report to stockholders. This tone of the annual report may reflect the management's philosophies, policies, or goals with as much accuracy as the audited financial statement should reflect the dollars and cents results for the period involved. The annual report may also, however, reflect little more than the skill of the company's public relations department in creating an impression about the company in the public mind. There is no way of telling whether the president has actually written the remarks in an annual report or whether a public relations officer has written them for his signature. Attractive photographs and nicely colored charts do not necessarily reflect a close-knit and able management team working in harmony and with enthusiasm. Allowing the general wording and tone of an annual report to influence a decision to purchase a common stock is much like buying a product because of an appealing advertisement on a billboard. The product may be just as attractive as the advertisement. It also may not be. For a low-priced product, it may be quite sensible to buy in this way to find out how attractive the purchase really is. With a common stock, however, few of us are rich enough to afford impulse buying. It is well to remember that annual reports nowadays are generally designed to build up stockholder goodwill. It is important to go beyond them to the underlying facts. Like any other sales tool, they are prone to put a corporation's best foot forward. They seldom present balanced and complete discussions of the real problems and difficulties of the business. Often, they are too optimistic. If then an investor should not let a favorable reaction to the tone of an annual report overly influence his subsequent action, how about the opposite? Should he let an unfavorable reaction influence him? Usually not, for again it is like trying to appraise the contents of a box by the wrapping paper on the outside. There is one important exception to this, however. This is when such reports fail to give proper information on matters of real significance to the investor. Companies which follow such policies are usually not the ones most likely to provide the background for successful investment. 4. Don't assume that the high price at which a stock may be selling in relation to earnings is necessarily an indication that further growth in those earnings has largely been already discounted in the price. There is a costly error in investment reasoning that is common enough to make it worthy of special mention. To explain it, let us take a fictitious company. We might call it the XYZ Corporation. XYZ has qualified magnificently for years in regard to our 15 points. For 3 decades there has been constant growth in both sales and profits, and also there have been enough new products under development to furnish strong indication of comparable growth in the period ahead. The excellence of the company is generally appreciated throughout the financial community. Consequently, 4 years XYZ stock has sold for from 20 to 30 times current earnings. This is nearly twice as much for each dollar earned as the sales price of the average stock that has made up, say, the Dow Jones Industrial Averages. Today the stock is selling at just twice the price-earnings ratio of the Dow Jones Averages. This means that its market price is twice as high in relation to each dollar it is earning as is the average of the stocks comprising these Dow Jones Averages in relation to each dollar they are earning. The XYZ management has just issued a forecast indicating it expects to double earnings in the next 5 years. On the basis of the evidence at hand, the forecast looks valid. Whereupon a surprising number of investors jump to false conclusions. They say that since XYZ is selling twice as high as stocks in general, and since it will take 5 years for XYZ's earnings to double, the present price of XYZ stock is discounting future earnings ahead. They are sure the stock is overpriced. No one can argue that a stock discounting its earnings 5 years ahead is likely to be overpriced. The fallacy in their reasoning lies in the assumption that 5 years from now XYZ will be selling on the same price-earnings ratio as will the average Dow Jones stock with which they compare it. For 30 years the stock, because of all those factors which make it an outstanding company, has been selling at twice the price-earnings ratio of these other stocks. Its record has been rewarding to those who have placed their faith in it. If the same policies are continued, 5 years from now its management will bring out still another group of new products that in the ensuing decade will swell earnings in the same way that new products are increasing earnings now and others did 5, 10, 15, and 20 years ago. If this happens, why shouldn't the stock sell 5 years from now for twice the price-earnings ratio of these more ordinary stocks just as it is doing now and has done for many years past? If it does, and if the price-earnings ratio of all stocks remain about the same, XYZ's doubling of earnings 5 years from now will also cause its price to have doubled in the market over this 5-year period. On this basis, this stock, selling at its normal price-earnings ratio, cannot be said to be discounting future earnings at all. Obvious, isn't it? Well, look around you and see how many supposedly sophisticated investors get themselves crossed up on this matter of what price-earnings ratio to use in considering how far ahead a stock is actually discounting future growth. This is particularly true if a change has been taking place in the background of the company being studied. Let us now consider the ABC company instead of the XYZ corporation. The two companies are almost exactly alike except that the ABC company is much younger. Only in the last 2 years has its fundamental excellence been appreciated by the financial community to the point that its shares, too, are now selling at twice the price-earnings ratio of the average Dow Jones stock. It seems almost impossible for many investors to realize, in the case of a stock that in the past has not sold at a comparably high price-earnings ratio, that the price-earnings ratio at which it is now selling may be a reflection of its intrinsic quality and not an unreasonable discounting of further growth. What is important here is thoroughly understanding the nature of the company with particular reference to what it may be expected to do some years from now. If the earnings spurt that lies ahead is a one-time matter and the nature of the company is not such that comparable new sources of earning growth will be developed when the present one is fully exploited, that is quite a different situation. Then the high price-earnings ratio does discount future earnings. This is because, when the present spurt is over, the stock will settle back to the same selling price in relation to its earnings as run-of-the-mill shares. However, if the company is deliberately and consistently developing new sources of earning power, and if the industry is one promising to afford equal growth spurts in the future, the price-earnings ratio 5 or 10 years in the future is rather sure to be as much above that of the average stock as it is today. Stocks of this type will frequently be found to be discounting the future much less than many investors believe. This is why some of the stocks that at first glance appear highest priced may, upon analysis, be the biggest bargains. 5. Don't quibble over eighths and quarters. I have used fictitious examples in attempting to make clear various other matters. This time I will use an actual example. A little over 20 years ago, a gentleman who in most respects has demonstrated a high order of investment ability wanted to buy 100 shares of a stock listed on the New York Stock Exchange. On the day he decided to buy, the stock closed at 35.5. On the following day it sold repeatedly at that price. But this gentleman would not pay 35.5. He decided he might as well save $50. He put his order in at 35. He refused to raise it. The stock never again sold at 35. Today, almost 25 years later, the stock appears to have a particularly bright future. As a result of the stock dividends and splits that have occurred in the intervening years, it is now selling at over 500. In other words, in an attempt to save $50, this investor failed to make at least $46,500. Furthermore, there is no question that this investor would have made the $46,500 because he still has other shares of the same company which he bought at even lower figures. Since $46,500 is about 930 times 50, this means that our investor would have had to save his $50 930 times just to break even. Obviously, following a course of action with this kind of odds against it borders on financial lunacy. This particular example is by no means an extreme one. I purposely selected a stock which for a number of years was more of a market laggard than a market leader. If our investor had picked any one of perhaps 50 other growth stocks listed on the New York Stock Exchange, missing $3,500 worth of such stock in order to save $50 would have cost a great deal more than the $46,500. For the small investor wanting to buy only a few hundred shares of a stock, the rule is very simple. If the stock seems the right one and the price seems reasonably attractive at current levels, buy at the market. The extra eighth or quarter or half point that may be paid is insignificant compared to the profit that will be missed if the stock is not obtained. Should the stock not have the sort of long-range potential, I believe the investor should not have decided to buy it in the first place. For the larger investor, wanting perhaps many thousands of shares, the problem is not quite as simple. For all but a very small minority of stocks, the available supply is usually sufficiently limited that an attempt to buy at the market even half of this desired amount could well cause a sizable advance in quotations. This sudden price rise might, in turn, produce two further effects, both tending to make accumulating a block of the stock even more difficult. The price spurt by itself might be enough to arouse the interest and competition of other buyers. It might also cause some of those who have been planning to sell to hold their shares off the market with the hope that the rise might continue. What then should a large buyer do to meet this situation? He should go to his broker or securities dealer. He should disclose to him exactly how much stock he desires to buy. He should tell the broker to pick up as much stock as possible but authorize him to pass up small offerings if buying them would arouse many competitive bids. Most important, he should give his broker a completely free hand on price up to a point somewhat above the most recent sale. How much above should be decided in consultation with the broker or dealer after taking into account such factors as the size of the block desired, the normal activity of the shares, how eager the investor may be for the holding, and any other special factors that might be involved. The investor may feel he does not have a broker or dealer upon whom he may rely as having sufficient judgment or discretion to handle something of this sort. If so, he should proceed forthwith to find a broker or dealer in whom such confidence can be placed. After all, doing exactly this sort of thing is the primary function of a broker or the trading department of a securities dealer.